All right, folks, we're approaching the point of no return. The S&P 500 is down a little over 17% as of today, if my calculations are correct. That is approaching that magic 20% line in which Wall Street declares it to be a bear market officially. The line that Jerome Powell has never allowed the S&P to cross. The Fed has stood stalwart at the 20% line in the past. They put a floor in the S&P. The most it has ever gone down was 19%, at least in the time that I've been tracking. In the time that this channel's been up, which I'm pretty sure before that, Jerome Powell's tenure, it had not been, it hadn't crashed, period, because I was around for 2018. That was that was the first big crash of Jerome Powell's tenure. We're now on the third. You guys starting to notice a pattern? Jerome's been in for just over 4 years, right? And this is already his third market crash. Really makes you think maybe the situation is just not as stable as the Fed has led us on to believe. But I can't speak too soon. I thought last time when we got down this low, I thought, oh my gosh, this is it. Jerome is finished. How can he stop? We've got lockdowns. Oh my gosh. How is Jerome going to save the stock market this time? And yet somehow he did. Now, we can go back in Monday Morning Quarterback and try to explain that now. But, at the time, I did not see the path. And right now, I don't see the path. We're down 17%. How does Jerome keep it from going below 20? And, of course, once it gets below 20 and it stays there, if Jerome does, then all of a sudden he loses, people are going to lose a lot of confidence in the Fed because Wall Street believes that there will never be another bear market again, or at least that's what they've been led to believe by Jerome Powell. Going back to Mario Draghi in, 2019? Or no, it was 2020, I think. Mario Draghi's famous line, whatever it takes. That has been the policy of Western central banks since the 2008 crash. Jerome Powell has made it clear on many, many occasions there will be no more bear markets, but yet here he appears to be engineering one in a matter of months. It was just a few months ago that Jerome Powell was saying that inflation is transitory and that, everything's going to be fine. There's no turbulence in sight. The Treasury Secretary, Janet Yellen, I believe, said there was never going to be another bear market in her lifetime. And yet here we are. We could be in a bear market in the S&P this week at the rate we're going. If the S&P is losing 3% a day, yes, I know it's not 3% off of the all-time highs. It's 3% off of whatever the opening price was. So it's not like, if it drops 3% tomorrow, we're not going to be 20% down. That's not how it works when you look at, how much it moves in a day. It's based off of what the open price was. So we need to lose 3%, more than just one day. But still, this week, we could be in a bear market in the S&P for the first time since 2008, or since 2009, to be honest, since 2009. And the bear market lasted for longer than just 2009, I believe, so we will be entering a bear market for the first time since 2008, or maybe it was 9 when we officially entered the bear market. Now, just to recap, the Fed funds rate is currently at 0.75%, 75 basis points. The Fed has hiked twice. Once they hiked 25 basis points. That's what kicked off this chaos. Then they hiked another 50 basis points, and that was just a week or two ago. And the top dove, one of the top doves at the Fed, somebody who's not even a voting member of the Federal Reserve Board, Neil Kashkari, president of the Minneapolis Federal Reserve Bank, he has said that he thinks neutral is at 2%. That's their way of saying we're going to hike rates to 2%. At least that's what Kashkari is saying, meaning that there's a lot of people at the Fed who think that they should hike a lot higher than that. We're currently at 75 basis points and almost in a bear market for the S&P. So the Fed funds is going to more than double, according to Kashkari. Where will the stock market be then? I think it would not be unreasonable to believe it would be down, 50%. Because if you look at how much the stock market has risen, just during Jerome Powell's tenure, leaving alone all of the asset price inflation under Janet Yellen for 8 years or so. Just looking at Powell's tenure, stocks have gone to the moon for no real reason. Price to earnings has just gotten way out of whack. The economy has not exploded in that time. The economy has been growing at a pretty anemic pace for a very long time now. Yet the stock market, which is supposed to be a derivative of the economy, because these are the companies that make up the economy, you would think that, okay, well, if the value of these companies is going up, that means that these companies are producing more. And if all these companies on the stock market are producing more, you would think, oh, well, the U.S. economy is producing more, and so the economy is growing at a proportionate rate. That's not the case. These companies, some of which, a lot of which, don't turn a profit at all, have just been going up in price. And that is asset price inflation. And so if the Fed removes all this accommodation, if they start taking away what created the conditions for this asset price inflation, if they try to reduce, because again, I think that the Fed, somewhat correctly, it's a good enough guess, because honestly this stuff is so complicated, I don't know anymore. I used to sound much more confident talking about this stuff, but then reality hits you like a sack of bricks, and I have to be humbled now. I don't know everything. But the Fed is operating on the theory that, okay, we've used the wealth effect since 2008, they were overt about that. Ben Bernanke said they were going to use the wealth effect to try and rebuild U.S. GDP, which is different than rebuilding the U.S. economy. They built back up U.S. GDP so that we were technically out of a recession, but GDP has been very lax ever since. It hasn't grown very much, but the idea is, okay, if we inflate asset prices, people will be wealthier. If people are wealthier, they can consume more, i.e. we'll run higher trade deficits, we'll import a bunch of crap from overseas, and that will be our economy. We will inject prosperity into the American economy through the stock market. And so by withdrawing wealth from the stock market, by devaluing the stock market, they are eroding the purchasing power of the American people as a whole, even though most people don't own stocks. The idea is that, well, even people who don't own stocks, they get business and revenue from people who do own stocks, and so they indirectly, so for example, you've got a rich guy, lives in like an $800,000 house, although that's not a very expensive house by today's standards. But let's say his stocks, the value of his stocks go up 30% in a year, and he says, you know what, I'm going to remodel my kitchen with all this money that I've made. And so he takes that wealth that he has amassed through asset price inflation, converts it into dollars to pay a contractor to remodel his kitchen. That contractor has now gained purchasing power because of asset price inflation. The contractor has indirectly benefited because he would not have received that work if the rich guy who owns, a big stock portfolio hadn't gotten richer. And so, it's basic, trickle down stuff. Even though, trickle down is a pejorative term, and it's, misused a lot by, basic shitlibs who don't really understand economics that much to begin with, but that is an appropriate term to use here. I mean, that's really the theory. It's the only way that, the wealth effect works. I guess you could also say that when regular people who don't own stocks look on the news and see, oh, stocks are up, that makes them, sort of feel like, oh, well, the economy's doing well, so I'm going to be more profligate with my spending. There's that theory, too. But the place where it has a concrete effect, where the wealth effect is making people richer and, in theory, leading to them spending more money, is people who own stocks. And so by slashing that wealth, the Fed is attempting to fight inflation. The crash of the stock market is a necessary condition for bringing down inflation under this view. And so, that's why I'm so split. the Fed for so long, Powell for so long, has made it clear. No more bear markets, and then here he is engineering one. It just, it feels so backwards. It's just, I still don't know that he's serious. I still don't think he's serious in his heart of hearts, because he's such a weak man. For more than 50% of me still says, when we get right on the edge, when we're 19% down, Jerome's going to come in and he's going to swoop in and he's going to cut rates back down to zero. But at that stage, cutting 75 basis points, what's that going to do? Even back in March of 2020, at least he had, I think, 2.25 basis points that he could cut. But looky here. As soon, back then it took a little bit. Back in 2018, it took a little bit for the Fed rate hikes to start impacting the stock market. Now that's also because we had the Trump tax cuts. If it weren't for the Trump tax cuts, I think that the effect of the Fed rate hikes would have been felt much sooner. People like Peter Schiff, who I was listening to before I started this YouTube channel, pointed that out and explained it very well at the time. I still think that analysis holds up very well. And so I think the Fed might actually be blindsided a little bit at how quickly their rate hikes are translating into a stock market collapse, because they don't have that cushion, that buffer of the Trump tax cuts, or any tax cuts, because the tax cuts are still in effect. They already happened. Once you do tax cuts, they are kind of a one-time thing, unless you want to cut taxes even more, which doesn't bother me. I would be happy to pay zero taxes. Because remember, tax cuts also have a stimulative effect on consumption and on investment. And so people, were taking the extra money that they had from the tax cuts. Corporations were buying their own stock, and so that was helping the stock market. They were doing lots and lots of stock buybacks back then, and consumers were just taking that money and buying, lots of cheap crap made in China. Oh, and did I mention the NASDAQ? I've been talking about the S&P this whole time, because the S&P is really what matters when you're trying to look at the psychology of the Fed. The S&P is the most important, that's the most important economic data point that the Fed targets. The Fed acts, we target interest rates. We target, inflation and unemployment. No, you target, for the entirety of Powell's tenure, he has targeted the S&P 500. In order to understand where the Fed is in its policy and what they're going to do next, looking at the S&P has been the best predictor. Not inflation, not unemployment. It used to be that the Fed considered 5% unemployment to be full employment, and at which point, it would be appropriate for them to start hiking rates. The Fed did not do that. And when I say unemployment, I mean U3, because U3 is the number that the Fed uses. And so if you thought that the Fed targeted, an unemployment rate of 5%, you were wrong. What they were targeting was the S&P, and they were targeting a higher and higher number year after year. But now, that's for the first quarter, and now into the second quarter, much of the second quarter, it appears that the Fed is no longer targeting a higher number on the S&P 500 index. I don't know what the Fed's internal price target is for the S&P. I don't know whether whether they think it needs to fall 25% or 50%. I would be shocked if the Fed really, would even internally think about tanking the S&P 50%. But it's clear at this point, if you got a guy like Kashkari who's in on it, they're doing it on purpose. They know what they're doing. And, Dudley, who was a former New York Fed president, and the president of the New York Fed is the second most powerful guy inside the Fed after the chairman. In fact, it used to be that the president of the New York Fed originally was more powerful than the chairman of the board. I forget the name of the guy who was he was a very early Fed leader. He was kind of seen as like the J. Edgar Hoover of the Federal Reserve. Once he was out of there, they really tried to rein in the office of the New York Fed president, but nevertheless, because that is the center of the financial system, not Washington, D.C., the president of the New York Fed is still incredibly powerful within the Federal Reserve System. And so Dudley, who's a retired New York Fed president, also a very, very, he's a major TDS sufferer. So keep that in mind, too. He's been, I think, pretty spot on recently with his analysis of the Fed. He sounded quite hawkish. and blunt in saying, what the Fed has to do. And he said before all this started happening, hey, the Fed's got to tank the stock market. That's what we got to do at this point. And remember, in hiking rates, the Fed, it's not like the Fed is really hurting the stock market. That's the wrong way of looking at it. What the Fed is doing is removing accommodation. Because what the Fed did was inflate artificially the price of stocks through their interest rate policy. Now they are removing the distortion in the market that they created, and stocks are returning to what their natural price would be. So, I think it's safe to say we're in the midst of it now. We're approaching the brink. We could already be well past the point of no return. It's funny. I was so caught up in the doom in the last two Powell crashes that existed. I was glued to it nonstop. And it's with this one, it's the third time in a row Powell's been Fed chairman, and I'm you know what? I can't let myself get sucked into this again. I can't fall for it again because it's probably going to be another fake out, and then the Fed's just going to flip flop. But it doesn't look like it this time. By this point, the last two times, then again, the Fed could flip flop tomorrow. I could be recording this video and then hit stop, and then look at Twitter and see that Powell has come out and done an emergency rate cut. Because that's how quickly he flip-flops. We went from balance sheet runoff is on autopilot to no more QT and no more rate cuts pretty much overnight. Powell said balance sheet runoff is on autopilot. I remember I was listening to it. In fact, this is how pathetic my life is. I was in the bathroom listening to a Fed press conference. I was that glued to it. I couldn't turn it off. I took my phone with me. Anyway, I don't want to get into any disgusting details, but it was a bright and sunny day. I could see the light streaming in, through the window. And then Jerome Powell said balance sheet runoff is on autopilot. And stocks fell off a cliff like they had never done before. Even though, that whole fourth quarter of 2018 had been, abysmal for the stock market. That was a turning point. And that's where Jerome said, you know what, I've gone too far. And he flip-flopped. And then 2020 came. And we had lockdowns. And I said, oh my gosh, this is it. How can the Fed fight this? How's the Fed going to fight the government telling people, oh, you got to stay home, don't work, don't leave your house? How could this not destroy our economy? And here I thought, hey, destroying the economy, that's going to kill the stock market, right? Because the stock market has some relation to the real economy. Nope. Powell just said, nope, we're cutting from 2% down to 0% on Fed funds, and we're going to do QE infinity. And whatever difference there is, whatever the stocks would have declined as a result of the lockdowns, we're going to make up for it, with QE. And again, Mario Draghi's words, even though he's the president of the European Central Bank, still applied to the Fed. It's the same logic. They were pretty well in sync. Whatever it takes. That's what the central bankers were telling us. But we're seeing synchronized across the West now. Central bankers keep hiking. The Fed hiked. The Bank of England hiked. I saw right after that the Czech central bank, which that doesn't make sense now that I think about it, because aren't they on the euro? But I heard something about the Fed or the Czech central bank was hiking. The ECB, I haven't checked in on them in a while, but Christine Lagarde, she's from another Latin country, so she probably is going to be a lot closer to Draghi than anybody else. It's not like they have a West German running the ECB. Inflation's pretty bad everywhere right now. And it's going to be a lot worse in Europe. I've been talking about the commodity crisis. I don't want to get into that again in this video. I want to make today about the U.S. financial system. So, I think it's clear as of today. If nothing changes, the stocks will continue to fall, and eventually that will bring down the U.S. House of Cards economy. what can change, the only thing that can change that might affect that is a Fed flip-flop. Because remember, the Fed saying, hey, we're going to hike rates and stop QE, that's what has led to this. If the Fed says, you know what, we're going to cut rates back down to zero and restart QE, that's worked every time in the past. So maybe it'll work again. I hope it doesn't work, because this isn't good. What the Fed does is not good. It's not good for the economy. It's not good for the health of the economy. Administering opiates to a patient with gangrene is not going to make them better, even though it might make them feel a little better. But Jerome and the gang have managed to kick the can down the road for years longer than I thought possible. I know they can't do it forever. That's a factual statement. It's just a mathematical reality. You can't unbake the cake. America's goose is cooked. It's just a matter of how long before we wake up and realize it. And in trying to rein inflation, because see, that's the difference here. We haven't had noticeable consumer price inflation in the past. It's all been kept under wraps. Now it's out in the open. And the Fed apparently does still feel some obligation to fight that inflation. But considering it is inflation that has masked the rot in the U.S. economy for all these years, undoing the inflation means undoing our phony prosperity. And so how long before the Fed realizes that that isn't the case? That they can't have guns and butter? That they can't have they can't have positive stock market growth year after year, double-digit growth in the stock market, and somewhat positive, even if it's 1 or 2% growth in U.S. GDP year after year after year, despite all the problems with the U.S. economy, without high inflation. You can't print your way to prosperity. You never have been able to. But once you've done all this, once you have built this house of cards, it has to collapse before you can start over and try to build a proper house. You got cracks in your foundation. It's as simple as that. And maybe the Fed thinks, that they can go through, another stock market crash and a mild recession, like we had in the past. Maybe Jerome thinks, okay, there can be a bear market and it's not the end of the world. It's not going to be a financial crisis like 2008 again. But if they let this turn into a real crash, I don't know if they're going to be able to bail out the entirety of the Western financial system this time, like they had in 2008. We're in a much worse position, exponentially worse position than we were back then. Because as every year goes on, the rot gets worse and worse. It gets deeper and deeper. And so, one of these days, I think the next crash will probably be the last one, because I don't think that the Fed has enough juice to cover up this much pain. So, I think I'm probably going to wait till that 20% mark unless there's big news before then. But again, at the rate we're going, that might be this week. I wouldn't be shocked to see a bit of a bounce off of 20%, to see a little bit of a rally, to see some support. But that support will ultimately be waiting. That'll be in anticipation of a Fed flip-flop. If that Fed flip-flop does not materialize, that bounce will not last. Stocks will then fall below 20% and eventually will resume a steady decline. So I see 20% as a speed bump because, I'm not the only one who has observed Powell and noticed, hey, he seems to really not like bear markets. And technically, we're not in one yet if you look at the S&P. Now, the NASDAQ, deep in a bear market, down almost 30%. But the S&P, everybody's favorite index, that is not the case yet. So, with that said, I will see you folks back here tomorrow.